Hey there, traders, and welcome back to FX Limit, the place where we dive deep into the world of Forex trading to help you become a more informed and successful trader. Today, we're going to delve into the essential topic of fundamental analysis, specifically focusing on the key economic indicators that every Forex trader should have on their radar. Now, if you've been trading for a while, you know that the Forex market is like a living, breathing entity, constantly influenced by various economic factors. Fundamental analysis is the art and science of decoding these factors to predict future currency movements. It's like being a detective in the financial world, piecing together clues to make sense of the bigger picture. So, let's kick things off with one of the most crucial indicators out there, GDP, or Gross Domestic Product. This is essentially the total value of all goods and services produced by a country over a specific period. It's like the economic report card for a country, and traders watch it like hawks. A rising GDP indicates a healthy, growing economy, which often leads to a stronger currency. On the flip side, a shrinking GDP can be a red flag, signaling economic trouble ahead. Next up, we have the Consumer Price Index, or CPI. This little number is all about inflation, measuring the average change in prices paid by consumers for goods and services. Inflation is a big deal in the Forex world because it affects purchasing power and can lead to interest rate changes by central banks. Higher inflation typically leads to higher interest rates, which can boost a currency's value. But if inflation gets too hot, it can erode a currency's value and scare off investors. Now, let's talk about employment numbers, particularly the non-farm payroll in the United States. This report shows the number of jobs added or lost in the economy over the past month, excluding agricultural jobs. Why does this matter, you ask? Well, a strong labor market usually translates to a strong economy, and that can be a green light for currency strength. On the other hand, rising unemployment can signal economic trouble, potentially leading to a weaker currency. Interest rates, folks, this is a big one. Central banks set the stage with their interest rate decisions, influencing the cost of borrowing money. Higher interest rates offer lenders a better return relative to other countries, attracting foreign capital and boosting the currency. So when central banks hint at raising rates, traders pay attention. The balance of trade is another key player. It's the difference between a country's exports and imports. A surplus, where exports exceed imports, can lead to a stronger currency as foreign buyers need the country's currency to make purchases. A deficit can have the opposite effect, potentially weakening the currency. Don't forget about political stability. Currencies thrive in stable environments. Political unrest, corruption, and uncertainty can scare away investors and lead to currency depreciation. So, always keep an eye on the political climate when you're trading. And lastly, let's touch on the Purchasing Managers Index, or PMI. This is a monthly survey of businesses that provides insight into their purchasing activities. A PMI above 50 indicates expansion in the manufacturing sector, which is a positive sign for the economy and the currency. Below 50, and we might be looking at contraction, which could be a red flag. So, there you have it, traders. These are the key economic indicators that should be on your radar when conducting fundamental analysis. Remember, trading is about making informed decisions, and understanding these indicators is a crucial step in that process. Keep studying, keep analyzing, and most importantly, keep trading. Thanks for tuning in to FX Limit, and we'll see you in the next video. Happy trading, everyone!